The collapse in oil prices that we have seen these days has very, very important implications on the global economy. Obviously, we have heard numerous analysis about what these prices mean for producers. Clearly, producers are going to find themselves in the impossibility of paying dividends and keeping the capital expenditure levels that they have been announcing in the past years. But more importantly, most of the capital expenditure cuts that will happen amongst producers will come from areas like refining, marketing, like gas and power, renewables, not necessarily exploration and production, where it is extremely costly to cut down production precisely now that they need to generate revenues. Remember that producers and global oil producers, particularly integrated oil companies, are finding themselves also in a completely unusual situation, which is that for probably the very first time in a very prolonged period of time, we are seeing that they are losing money in refining, in marketing, in gas and power. They're losing money on almost all of the divisions. And as such, the cash flow implications and the balance sheet implications are going to be extremely severe. But that is on oil producers, or the state owned companies obviously are also going to find a very, very important problem. The first problem being that these companies finance a lot more than expenditure on oil and gas. They finance civil servants' salaries. They finance a lot of subsidies for the overall economy in their countries. So a lot is going to happen as well in terms of the expenditures of those countries in social services, in subsidies, in so many areas that have nothing to do with oil and gas. The implications are also monetary. Global emerging market currencies are collapsing, and they're collapsing at the same time as the countries are losing FX reserves by hundreds of millions of dollars a day. So there's a very important implication as well, which means that these countries have to face some of the largest levels of maturities in foreign exchange denominated debt in 2020 and 2021, around $2.3 trillion. They need to face those maturities with diminishing reserves, diminishing exports, and diminishing price for those exports. So the collapse in demand is so severe that there's very little that they can do also in terms of addressing the problem through supply cuts, because it cannot be addressed when it's of the levels that we are seeing right now, that leads the United States to have a problem of storage that will be very likely to happen as well in other parts of the economy pretty soon, not just in the United States. It also has impacts on the financial sector. One thing that you will probably listen to a lot these days is that the exposure of the financial sector to the oil sector is quite limited. Absolutely, it is. But another very important factor is the exposure to the oil and energy complex. What does that mean? How much of infrastructure, of construction, of engineering, how much of things that are directly or indirectly linked to the oil and gas sector and the commodity sector and emerging markets is financed by banks. And this is much larger. This is much larger when those emerging markets have been the main area of growth and of development of new financing in the last years, looking for some level of return compared to developed market, very poor returns on net income margin or on lending in general. So financing of those activities has been a big driver of growth for banks, and now they find themselves that they have a large exposure to countries in which the currency is collapsing. The ability to repay foreign exchange debt, foreign exchange denominated debt, is also very limited, and the export levels and export prices are collapsing. So it's not just the exposure to oil, it's the exposure to the entire emerging market producing, commodity producing countries. There are also other important factors to consider in this slump. The idea from of governments and the idea that many central banks and that many investment banks are selling about a V-shaped recovery is becoming almost impossible. The reason why it's almost impossible is fundamentally because the long-term implications that have already been created, both in supply chains, but also in the ability to finance the economy, are almost impossible to predict. Almost impossible to predict. We are going to face, therefore, because of the slump in commodity prices, first, a massive deflationary wave that is very difficult to address with demand side policies because there's no demand to incentivize. And even if you incentivized a bit of it, it would not generate higher levels of supply. And that is a key factor of the problem. The key factor of the problem is that most of the policies that have been implemented by governments will lead to stimulate the areas of the economy and the sectors of the economy that were already excessively stimulated, that were already in overcapacity, and that were already in the process of obsolescence. So stimulus are targeting fundamentally the sectors that are of the old economy. And what governments are going to do is the following, particularly because of the collapse in oil prices and the impact on emerging economies. What their governments are going to do, and central banks will finance, is maintaining the past at all costs, whatever it takes, and at extremely low rates and massive levels of stimulus, while at the same time not paying any attention to the future, not paying any attention to the future, while startups, while companies that are developing the new technologies that will give us better and more services, while all the small businesses that are driving productivity higher, all of those are collapsing. And what will be rescued will be the parts of the economy that were actually in the process of obsolescence. The falling in commodity prices is so severe because nobody, even the ones that are bearish like myself about the recovery, nobody expected that we would have such a level of impact on the supply and on the demand side as quickly and as aggressive. And what's very concerning is that what we continue to hear from governments is that the idea is to try to find ways to pump prices up artificially. So trying to get supply cuts in the oil market, which are not going to work, by the way, because the problem is of an absolute collapse in demand. There is no demand. Second, trying to stop the price and signals coming from the market by intervening in markets and putting minimum prices to some activities. You see what is happening? What is happening is that on one side, you have a government-forced shutdown of the economy that leads to a massive deflationary spiral because demand collapses and business starts to fall, unemployment goes through the roof. Governments present themselves as the solution. They implement more protectionist measures, more interventionist measures. They try to drive prices up even when demand is poor, even when unemployment is very high, and when consumers are suffering. They try to drive prices up so that inflation doesn't fall any further, and then what they create is stagflation. This is the first wave of stagflation, a massive deflationary spiral, because the little supply that is out there to address the demand that we would have even in a pandemic is completely destroyed in price by the shutdown of the economy. And when the economy comes back, the level of unemployment, the level of overcapacity, and the level of intervention that governments have implemented is so severe that the economy doesn't recover as quickly. Also, the financial sector is so irreparably damaged that not only it has to address the rise in non-performing loans coming from the exposure to emerging markets. It also has to address the rise in non-performing loans in the developed economies and financing the monster programs that governments have announced that basically are looking to bail out the old economy. So governments, what they're trying to do is to defend the past at all costs while talking about the future. And by doing that, the misallocation of capital, this is not going to be as it was in 2008 or as it was in 2001. The misallocation of capital this time is going to be so drastic that we will find monster overcapacity and very deflationary actions in the sectors that are currently in overcapacity and that we're already seeing deflationary aspects, and destroy the ability of the economy to deliver on more economic growth, better productivity, more technology, and displacement of the old industries, because that area is not going to find the capital to be financed and is being completely left behind out of this so-called process of recovery. Therefore, the slump in oil prices is simply a red sign, a red alert, a very, very significant alert that is telling us what is likely to happen in the future. And that what the way that governments will act by trying to keep prices up at any cost through monetary and fiscal policy will drive to further problems of economic growth, productivity, debt, and stagflation ultimately in the future if things continue this way. There are easier ways. By the way, there are solutions. What is the solution? The solution is to let all that massive amount of capital that is currently idle and wants to help the economy get back on its track to work, to let investment come back into the economy, to let the economy start to breathe and to manage the cycle and to manage the environment in which we live in, if the pandemic, having the correct equipment and the correct protocols to manage the supply chains from the market and from companies. That is not what governments want to do, unfortunately, and therefore that's why it's so risky what we are seeing. Thank you so much.